to chime in. Oh, anyway, if you want to chime in, raise your hand, and one of the co-hosts will call your name. Otherwise, feel free to always type in the chat. We'll monitor the chat. Okay, and then the agenda of today's webinar is pretty tight-packed. In the first half of the hour, me and Keanna, we're gonna go through a few, I would say, important topics. We're gonna go through the concept of cash management for CPG brands. What are the key metrics you should monitor? We're also going to go through business credit and underwriting for CPG brands. And Keanna obviously is the expert here. She's gonna share tons of knowledge about business credit and underwriting. And specifically, I asked Keanna to share because she's working with SETTLE now. She's gonna share some tips from SETTLE underwriting behind the scene perspective. What are some of the tips as a CPG founder if you go out looking for, let's say, inventory financing, and if you work with SETTLE? After that, I will ask Ash to share a quick case study and experience working with both of us, and then we'll get to, I will make sure in the last portion, I would say 10-15 minutes at least, if not more, to have you ask questions. So we'll have a Q&A session. Depending on how many questions you have, we can expand Q&A as well. Right, and then at the end of the session, as I mentioned in the newsletter, we do have a special offering from both SETTLE and MyPocketCFO to the people who participate in this meeting live, especially. And we're gonna announce the special package. If you want to take advantage of that, you can follow up with us right away. I think that's about it. Anything else, Keanna, I missed?
No, excited to chat today.
Sounds great. Okay, cool. So actually, that's the thing, is if you do want to follow us, here is the page from those two companies. We encourage you to follow both companies on the LinkedIn, on the Eventbrite page, and also SETTLE has great blogs. I personally read their blog website a lot, so do go there, check it out. With that being said, without further ado, I'm gonna ask Keanna and then Ash to introduce yourself.
Awesome. Thanks, Alice, and super excited to chat today. As Alice mentioned, my name is Keanna. I lead the credit function here at SETTLE. My background is specifically in commercial lending and credit, and has been for the past 10-ish years. A big theme of my career has been supporting companies who build physical products. So I started my career at SVB. There I worked at structuring venture debt and asset-based loan type products. I then got my feet wet in fintech at a company called Flexport, which many of you may be familiar with. They're an international freight forwarder who a lot of CPG e-commerce companies use to support the logistics of moving goods into the US, but they also can help finance in the build and import of these goods. So worked a lot on inventory financing there as well. I personally find supply chain fascinating, and it's continuing to evolve as we see with the change in direct-to-consumer buying. So kind of marrying those two experiences, I've now been here at SETTLE for around 2 years, blending both my banking and logistics experience to find fast, nimble, and effective solutions for e-com and CPG businesses. And, you know, when Alice brought this idea up to do this chat, I was really excited because I feel like it's a little difficult to navigate not only the cash flow conversation, but the debt conversation for really early stage businesses. I've personally underwritten venture debt loans, asset-based loans. I've provided vendor payment terms, and now have been in the alternative financing space for a few years. So a lot of tips and tricks that we can help share with our customers and be very consultative to help their growth.
Awesome to hear. Thank you so much. Ash, you want to give a brief introduction of yourself as well?
Sure. So my name's Ashley Nicholson, and I am the founder and CEO of a company called BTR Nation. And we are an on-the-go snacking company that removes sugar from all of your favorite snacks, but makes sure to infuse good-for-you superfoods. So we really are the best of both worlds for consumers. So we have been in business for about 2.5 years. And for our first really 1.5 years in business, we were mainly direct to consumer. And that is my experience. Prior to starting B.T.R Nation, I worked at a supplement company as the director, as the head of sales and marketing for many years. And D2C was what I knew, and that was a great opportunity for us to launch into the market and get our first, tens of thousands of customers. And now, why I'm so excited to be here and talk about cash flow management is because I'm living it day in and day out. I used MyPocketCFO and SETTLE extensively this morning as we prepare for our biggest quarter ever. So we are in massive amounts of production of all of our SKUs right now. So really excited to talk more about how I use SETTLE, cash flow management, all the things. But I'm also really excited to hear from Alice and Keanna about these tips and tricks because I will be implementing them as well.
That's awesome. Thank you, Ash. One thing, I found the common theme for both of you, Ash and Keanna, is when I look at your background, both of you, you're so focused. Keanna, like when I look at your professional trait, the trail you've been like you said, right? You've been in commerce infrastructure, you've been supply chain, and you've been commercial lending and then credit. It's just it's very focused and up until today with SETTLE is to help CPGs to unlock their cash flow, working capital. And Ash, I know you had a biochemistry major in public health in your undergrad, and then after that you've always been in the food businesses, and now you have your own brand focusing on wellness and health through food. So I personally, I feel that's incredibly inspiring to learn from both of you, like how to stick to a passion and go further down and bring yourself to the point where you can have your own brand, your company, and also you can help many other companies achieve something you're deeply knowledge of, right? So anyway, that's my takeaway from your intro. And now let's dive into our today's topic, cash flow management. So when I think of cash flow management, I think of, I would say, 3 things actually. Obviously, because I come from CFO background, I help or advise CPG brands to manage their you can think of their financial aspects of their business operation. And when it comes to financial aspects, obviously we're talking about managing their P&L, right? Manage profit and loss, manage their balance sheet, and obviously their cash flow statement. So when I think of their P&L, I think of P&L is kind of like a reflection of your current business activity in terms of you're burning cash. Basically, you're receiving cash, meaning cash inflow, or you're burning cash in expense format to propel your business growth, right? In the early stage of a CPG brand in your journey, typically the cash bringing in is less than the cash you burn. And that's because the nature of CPG brand is, I think Keanna and I talk about the concept of CCC, cash flow conversion cycle. For a CPG company, cash conversion cycle is typically quite long compared to, let's say, a SaaS company, like us. That's because like way ahead of the time, you have to inject or input cash, you have to pay to like raw material provider because you're producing physical goods, and you have to pay them 3, 6, or even longer ahead of the time to produce the product. And then after production, you have to store them in the warehouse, you have to manage to sell them, and then you have to ship it to the customer. And if you go through channel partners like retailer or wholesaler, you have to wait for months for you to collect the cash, right? So because of that nature, I think almost across the board, your cash inflow will be short than your cash burn on the P&L. That puts a lot of pressure on your balance sheet, in my view, from a CFO perspective. Balance sheet, in my view, in essence, is where you store, you basically accumulate a bunch of assets so that you can burn them in the future. So you can think of balance sheet as the asset you're accumulating in preparation for you to burn. And when you burn, the burn will be reflected on your income, on your profit and loss statement. So you can see how balance sheet flows into profit and loss statement, and profit and loss statement needs to draw from your balance sheet. And that's when, when we review those financial statements, we review the balance sheet. So when we review your balance sheet, we look at your current asset and current liability. We look at your working capital. So a quick way to think of your working capital and cash flow, well, cash obviously is all the cash in your bank you can draw right away. But also we also look at your inventory level, because once you ship out your inventory quickly, they could be turned into cash. We also look at your accounts receivable. If you have, let's say, 30 or 60-day due date, you may collect cash within a short period of time. And also we look at your accounts payable, which goes under current liability, right? So your working capital is really your current asset minus your current liability. And we look at how much working capital you have. That give us indication in terms of how much you can draw to burn on your balance sheet to finance your activities, like a big production. Oftentimes, even that is not enough by yourself. And that's when you have to think about getting some, we call leverage, right? Like go out and collaborate with lenders like SETTLE to beef up, in my view, to your balance sheet and working capital, especially if you're on the growth mode, you have large production cycle to go. So that's kind of how I view a CPG company, manage the working capital, the cash. So when you think of cash flow, don't think of it as fixated. Think of that as a flow, a cycle, cash conversion cycle. And also think of your working capital in terms of current asset and current liability, how those flow into your P&L, so you can continuously have a stream to have a fuel to burn, right? So that's kind of how I typically will start with my CPG brand. I'm gonna throw that question to Keanna. What's your view on cash flow and some of the key metrics you would be looking at from both CPG brand perspective and also from your perspective?
Yeah, definitely agree that it's dynamic and a cycle. I usually describe cash flow management as a balancing equation where you're trying to align your cash outflows, so your expenses, your AP, what you're investing in your inventory, with your cash inflows, so your sales, your accounts receivable. This requires a pretty solid understanding of where there are strengths and weaknesses that exist in your supply chain and what solutions are available for you to fix them. Some of the questions that I ask in diligence with our customers that I think every business owner should be able to answer, and these are the root questions to understand what your working capital gap is. Number one, from the day you instruct your manufacturer to build inventory to the day that you receive cash from sale of your product, how long does that take? As Alice mentioned, with companies who are building physical products, these cash conversion cycles, that's what we call it, can be upwards of 5, 6, 7 months. And when you're floating that amount of capital for that long, it creates a very big strain on the business. So depending on how long your cash conversion cycle is, this will determine whether or not you need to maybe look at low to no cost non-debt options, or if your working capital need is very long, you may need to solve them with a debt option like SETTLE. The other question that we also ask is, you have a plan to do 20 million in revenue. Great. How much inventory do you need to get there? How much sales and marketing budget do you need to get there? How often are you injecting capital into your supply chain to get the goods? And a lot of these questions say, what we try to boil it down to is, at any point in time, how much cash am I paying to my suppliers and vendors that are going to be tied up for maybe a couple of months that I need to reserve on my balance sheet so that I can pay my vendors and suppliers? If, for example, most of the businesses that we look at, on average, they're carrying 90 to 120 days of inventory so that they can help support forward sales, not be in a position where they're stocking out. And that may, 90 to 120 days of inventory when you're small, maybe a couple $100,000 worth of goods. When you're large, it may be a couple million. So really understanding what that cost is and what that total cash is that's going to be tied up is going to drive when you should be having conversations about debt or non-debt options to help float that gap. So knowing the answers to those kind of basic questions are going to help you get in front of the right partners at the right time. And I always say this is something that needs to get done when your business is at its simplest. So when you're selling only direct to consumer, you have one supplier, that's where that equation is going to be simplest. As you start to get into different regions, into different distribution channels, you're diversifying suppliers, the cash flow management aspect gets very complex. So having an understanding of the different levers that you pull in your business and how that impacts cash, inventory, inflows and outflows is really, really important to do when you're young.
That's awesome. Thank you for bringing that up. That actually leads to the topic of cash flow forecasting, which we partner with our clients to do that, especially if they're in need of a alternative financing or even equity financing. So cash flow forecasting is a key to that. And then when it comes to cash flow forecasting, I think the simplest version of that is, like Keanna, you said, it is really just lay out your let's say monthly net cash burn, plus I would say your accounts receivable in the near future, and minus your accounts payable in the near future. So, and its simplest term, that's basically MyPocketCFO. When we work with our clients, we try to come up with a kind of very basic, I would say, baseline in terms of their cash forecast for the coming 6 or 12 months, right? And if we see that the cash level is not enough, let's say to propel for you to burn, especially if you're on the growth mode, you just signed to expand to a national chain of, let's say, 30 stores, something like that, then you would be thinking about alternative financing. Typically, we recommend you to think about alternative financing before you think about equity, because you want to go with non-dilutive route first, right? So when it comes to alternative financing, obviously, it leads to the next topic, which is credit and underwriting. Because when CPG brands go out talking to lenders like SETTLE, obviously the underwriting team of the lender will be hold a second. Samuel is requesting to record this meeting locally. We are recording. We are recording for the entire session, and we're gonna send out afterwards. So don't worry about recording locally. Okay, going back. So Keanna, it would be great for you to share. We also talked about there are different formats of alternative financing. There's revenue-based alternative financing. There's also a asset-based alternative financing. I know SETTLE is a little bit unique. You call yourself working capital-based because you do finance based on projection, not purely based on inventory or historical number. So why don't you just dive in and share your perspective on different ways of alternative financing, and what are the ways SETTLE is working with your clients?
Totally. First, would love to define business credit, because I think there's two forms. One is a non-debt option, and the other is a debt option, which we'll dive a little bit deeper into. But there's two types of financing, and kind of touched on it earlier. The first is your vendor or supplier payment terms. This is going to be the terms for which you have to pay upfront for your inventory build, and based on once they send it out, when the remaining payment is due. Typically, we see for companies that we work with anywhere from 25 to 40% of the cost of inventory is due up front. And then the remaining is due net 30 to net 45 days after shipment. It's pretty standard across board. That is a negotiating term that you can use to help manage your cash flow over time. The second being debt financing provided from a lender. So as we mentioned in the earlier question, the cash flow management piece is really just an equation. And ideally, in a perfect world, you'd be paying your supplier for the goods at the same time that your customer is paying you for the goods. Now, we know most of the time this hardly ever aligns, and that is what we call a timing gap, the working capital gap, cash flow gap. There's a lot of different buzzwords that are thrown around for it. But at the end of the day, there's different ways to reduce that gap. First and foremost, on the vendor supplier payment side, I call this a free form of business credit. So when you're engaging in a relationship with a new manufacturer, based on financials you provide them or connections that you have, they may say, instead of you paying 100% of those goods up front, I'm actually going to lower that to 30, 40%, and I'll trust you to pay me at a later point in time. Usually for small companies, you don't have a lot of leverage, and whatever terms they provide you, you kind of have to go with it. But over time, as you build repayment history and a relationship with that supplier, there is negotiation available where you can elongate the time that you pay that supplier back and also shorten the percent that you have to pay upfront. So I always, push customers after a couple of years to say, go have conversations with your supplier, maybe diversify your supply chain so you're getting better blended pricing better blended terms, because those are free forms of business credit and a component of your cash flow management. The second form of business credit is debt financing from a provider, a lender like SETTLE. And that's going to be the most common for early stage companies because, as we mentioned, it's going to be hard to negotiate with suppliers when you're doing low volume and you're really young. So your lender actually takes on the working capital gap for you. So they pay your suppliers or use the capital to pay your suppliers. And then when you get paid from your customers, you then pay your lender back. Obviously, there is a cost to that. So I always like to give an example of how these two forms of credit work in tandem. So for example, if I'm a business, I have a 90-day cash conversion cycle. If I get 15-day terms from my supplier and 75 days with my lender, that floats my entire 90-day cash conversion cycle. But if after 2 years, I've been working with my supplier, I've paid every bill on time, I say, hey, I want actually 30-day terms. Will you grant this to me? Great, supplier says yes. You then have 30 days of free float that your supplier is giving you, where you can shorten the duration that you're putting on your working capital provider to 75 days, which means on average, you're saving 15 days of interest. And so this actually becomes a very dynamic equation. 15 days of interest means that your cost of capital or your margin that you're paying is going down, your margin is increasing. And you're also leveraging free form of credit to be able to float your working capital cycle. At Flexport, I worked with enterprise type companies who were doing hundreds of millions in revenue, and they were actually able to garner net 60, net 90-day terms from some of their manufacturers. So it is possible to get there, but again, the relationship and the repayment history has to be demonstrated. So it's a very balancing act that happens. In terms of the types of lenders that are out there, there's a lot of different solutions, especially in the alternative financing space. And they each look at underwriting similarly, but different. So I like to kind of highlight what are some of the most general metrics that persist across all of those lenders. And then maybe in the next discussion topic can kind of go into the differences between SETTLE and ABLs, SETTLE and revenue-based finance providers. So in general, what lenders are going to evaluate is based on their loan type. So what a venture debt lender is underwriting to is very different from what an ABL lender is underwriting to. You as a business may qualify for both types of loans, but the availability, the mechanics, the pricing, they all may look different because each of those underwriters are valuing either your revenue, your cash, your assets differently based on their model. Most of the general metrics, and the number one that I say is most important, is revenue growth. Lenders want to invest in a company that's, number one, going to be around for the long term and that has positive traction in market, product market fit, to say that company or users are going to continue to buy this product. With that, we also look at unit economics. And I think this is a topic that's been discussed not only on the lending side, but in the equity markets right now, because there's not as much capital available on the equity side. So lenders and investors are wanting to ensure that companies are not growing at all costs, but being very mindful of how they grow. I'd say in 2020, 2021, we saw a lot of companies burning and injecting a lot of capital into paid marketing. And it would the cost to acquire a customer was way too high to be sustainable. Now we see a lot of companies scaling that back, being very thoughtful about how much they invest in their customer acquisition costs and ensuring that there's positive unit economics there. Unit economics also flows down to the bottom line. So how much is your net profit loss on a product basis, and is that improving or decreasing over time? Another one that's really important is, as Alice shared earlier, you are either a cash burning business or a cash generating business. If you are a cash burning business, it's likely that you are going to need to have equity providers or plans to turn cash flow positive in the future. And having a very clear path to getting there will be important when we think about the longevity of businesses and their ongoing ability to have cash runway. That will be kind of like the fourth piece that a lot of lenders look at, but value differently, is liquidity. How much operating cash do you have to continue to sustain your business? If it's 6 months, what are your plans in 6 months to continue to have cash on the balance sheet? A lot of those questions come up in upfront diligence as well as through portfolio management. I'm sure as Alice and team are going through your projections for the year, kind of modeling out where the cash position is, that is also a conversation that has to come up. If you're getting to a low point, you want to have a little bit of cushion so that if revenue or sales volume doesn't pan out to how you want it to, what are alternative paths, plan B, plan C? A couple other ones that are also important is, how has your historical ability been to sell through your inventory and collect from your customers? Sometimes, ABLs will get very granular into your SKU performance. We can kind of touch on that and see that in the numbers if we see really high and non-moving inventory balances. But we want to understand, of the inventory that you're procuring, are you selling it in a timely manner? If not, why? What are your plans to liquidate that? Because lenders want to invest in inventory that's going to be sold and converted into cash. Additionally, if you're selling into retailers, are you partnered with the right partners who are going to pay you on time? I always say Costco is one of the best payers I've ever seen from an AR perspective. So whenever I see that on the balance sheet, it's very positive. But there are some wholesale providers or retail partners that you work with that may have a really slow repayment time and they're always late. So that's something a lender may also dig into to understand how fast you're going to get paid on that inventory. And then the last but not least, which I think is really important, especially coming from a lender, is how many debt providers are you working with? How much debt do you have outstanding? And do you actually have a plan or an ability to be able to service it? There are some debt solutions that sit on your balance sheet for a very long time and then they come due all at once. What's your plan to repay that? There are other debt facilities that are constantly revolving, and as you sell product, you're paying it down. So your ability to be able to service that debt in the future is really important, especially as a new lender or a new partner wants to come in and inject more capital in your business.
Amazing. That's so much to pack into like a few minutes. I'm sure we will have a chance to dive into, any one of those points. We could do a deep dive session, but I would say from the ones you mentioned, Keanna, I'll do a quick summary here. You mentioned to begin with a CPG brand, they can actually, even before talking about financing, they could optimize, I call optimize their time gap between their cash receivable and payable, basically. So that seems could be the first tactical things as a CPG brand operator. You could try to optimize, and then you could look for debt financing, different vehicles. For the debt financing, I would say lenders, couple of metrics you're looking at. Revenue growth seems it comes to the top of the mind, because everyone wants to partner with a growing brand, right? Unit economics, what I heard, is really important, especially since the pandemic. You want to look for signals to tell you it's profitable or going to be profitable on a unit basis. And then obviously the bottom line, are you on the way to overall profit, right? And your cash burning, what's your cash runway, your cash burning cycle, and liquidity, and also your inventory turns, who are the retailer or wholesaler reputable, and also the current debt outstanding. So those are great, I would say, key metrics as a lender. You're looking, that's quite a lot. But I also know that, Keanna, from my experience working with you, I know some of my MyPocketCFO's clients, for some of them, it's pretty straightforward. You give a line of credit right away. Some of them you based on my observation, you reject it first, but then later on you say, hey, we have a new product. We can actually lend you a line of credit based on some of the forecasting you've done. Recently, we also have another client where, they had a revenue-based financing, and then you are actually working with our client to basically move or convert from revenue-based to inventory-based, because inventory-based, or in your specific case, can save them some cost. So can you, I would say, given that, I've seen, that's what's really impressive for me, is you're able to work with all kinds of our clients in their early stage to accommodate to their specific use cases. And in any one of those cases, you manage to give them some credit, be able to lend to them. Can you just touch base quickly? I know we're running out of time here, but just quickly on the type of the credit you give for different use cases.
Yeah. And it's something that SETTLE is very mindful of. We need to evolve our product to fit different user bases. What a company who's doing 500K in annual revenue needs is not the same thing that a company who's doing 50 million in revenue. And so that's kind of where you see maybe sometimes we're not able to get comfortable, not only based on size, but maybe the existing debt stack. And as we continue to iterate on our product, we can find maybe starter solutions where we can get comfortable building a relationship and scale to more of SETTLE's typical product. So in general, how SETTLE looks at financing, how we size it, how we structure our repayment, we're blending a little bit of holistic underwriting. So we're taking a look at all of those metrics that we had talked about before and saying, based on what I know about the company and how they've performed historically, do I believe they are going to continue to grow? And if so, if they continue to grow at a rate of, 10% month over month, what is the forecasted need going to be from a liquidity and inventory perspective? Sorry, I'm getting a little feedback. Gabe, sorry, I'm going to mute you there. So we take a blend of historical approach to provide validation to the projections, but then we help support projected growth in real time. So a perfect example of this is if you were to be working maybe with a more traditional bank line of credit, an asset-based loan, they're going to say your borrowing availability is based on your historical performance. That's the formula. With Settle, we can say, hey, I've seen you expanding into Targets nationwide. You're now then going to expand into Walmart. But to do so in Walmart, you actually have to deliver $1 million worth of products. With a traditional bank line of credit, they're going to say, no, your borrowing availability is based on something in the past. Settle can say, yeah, we can see the purchase order. We believe you have the ability to grow into this forecast. We'll actually give you the capital now so that you can perform into that purchase order. So we take a blended approach of historical and projected. Now, there are other solutions in market that solely look at projected. So you're talking about merchant cash advance providers or revenue-based finance providers, where they actually have models that forecast out your revenue. And because of the way that they're structured, they're taking a percentage of your revenue every time you sell a product. And so the underwriting differences are pretty big because we're looking at, as a working capital provider, a company's ability to take that asset and convert it into cash, whereas a revenue-based finance provider is looking at your ability to continue to grow your revenue. And that repayment structure is very set. So with Settle, how our repayment structure works is we're typically looking at your cash conversion cycle specific to your business. So if one company's cash conversion cycle is 90 days versus another one's 180, you're going to get different terms based on your specific business. Settle is structured as a set repayment schedule. It's kind of like a little mini amortized term loan. Or a bullet structure, so meaning you'd pay a lump sum in the future. And that makes it really easy for cash forecasting. However, it does mean that you need to perform pretty closely to plan if your cash is tight. Whereas with a revenue-based finance provider, because they're taking a percentage of your revenue, they actually have first access to cash and then you get the remainder. So it's a little bit more, I wouldn't say mindless, but it's kind of set it and forget it. The main differences with the two products, though, is that Settle's costs are very fixed because the repayment window and the cost is set. With revenue-based finance, if you're growing really quickly, your repayment window can actually be shorter or longer, and the cost based on that can vary pretty frequently. So there are definitely circumstances where companies are working with one type of solution or the other and want to switch based on, cost reasons, size reasons. And it's actually a really delicate dance. It's hard when there's a lot of different debt providers working with one company, because at the end of the day, they're all trying to get repaid from the same asset sale. So in general, we like to say rule of thumb, 2 to 3 lenders is probably the max at which we'd like to see. One sole lending provider is ideal for any financing institution, but it's likely that companies are going to be using a couple of different sources. So in general, revenue-based finance versus working capital, one is not better for another business or the other. It's really dependent. And what I like to ask is, what is the most important thing for the company right now? Is it the amount of capital? Is it the cost of capital? Is it the flexibility of repayment? Is it the ease of cash flow forecasting or how I repay this loan, which is going to drive which solution that companies choose?
Perfect. That's actually a perfect point for me to turn to Ash. Ash is MyPocketCFO's first customer, and over a year time frame, we have been working with Ash to really try to help her to grow her businesses. Ash, in my experience, Ash is a genius sales marketing plus a food scientist. On the finance side, we're trying to partner with her really, while she is full speed on sales marketing, opening all those new channels. We're trying to strategize alongside her to see how we could help her to build literally a portfolio of lenders that could not dragging her growth, but instead to empower and propel her growth. So Ash, with that being said, I would like to ask you to share your experience of cash management and working capital financing, especially working together with both Settle and MyPocketCFO.
Yeah, absolutely. So excited to share. And I've been taking a bunch of notes, Keanna. So thank you for sharing all of these wonderful nuggets. So for us, we, as I had mentioned earlier on when I introduced myself, we were about 80% of our business was D2C. So it was very controlled. I had a good idea of what the input would be. So if we run a certain campaign, I had a good idea of what the output was going to look like. Things have gotten a little bit different as we expand into retail and as we're preparing for our largest retail launches ever in the next couple months. Things have gotten crazy. So that's the easy way to say it. So for us, we actually were mainly using a revenue-based form of financing, and we were using Shopify Capital because it was nice and easy. It was a click of a button. It was very effective because the majority of our revenues were coming D2C, and it was really, like Keanna shared, this set it and forget it, because it was just coming at, a certain remittance from our daily revenue on Shopify. As we, are starting to get yeses from retailers and, be preparing for these launches, things have changed because we know our cash flow conversion cycle is anywhere between 2 and 6 months. So it's challenging because each channel is a bit different. And I really look to Settle for an opportunity to help us expand in a nice, seamless way. And being able to work with MyPocketCFO for as long as I have, I joke about this with Alice, with you all the time, because I feel like I use MyPocketCFO so much that I basically break the app, because I'm constantly looking at, our snapshot page on MyPocketCFO, which literally shows me everything at a glance. So cash in hand, all of my receivables, all of my payables, every, revenue by channel. And to me, I'm looking at that daily. And knowing, that we need to produce for just massive accounts that are coming online, I have come to Settle to really help us expand and to be able to, help us produce that inventory without having to use equity-based financing for working capital, essentially. And Settle has been so easy to use. So I've had such a wonderful experience where it's literally from a brand perspective, uploading an invoice, making sure that the account and routing numbers are correct, setting the payment terms and the financing payment terms, and clicking submit. Like, it's so easy that our suppliers also love that because they get paid on time from Settle. We can show them, how they're getting paid, and it's been a really, really amazing process. We also do rely on our suppliers for these. I've negotiated some incredible payment terms from our suppliers. So we have a relationship with one of our bar co-packer, that it's 20% deposit and 80% net 30 upon shipping. So that's really great. Our chocolate co-packer is different, right? It's 50% and 50%. So that, some of our cash is a lot of our cash is an inventory. So really working with our suppliers have been very helpful as a way for us to just have some more, just preserve our cash flow and have more runway there. But I'm grateful for, a company like Settle to make this just such an easy process. We haven't even looked at like an option for a bank loan. We also have only been in business for 2.5 years. So we really love the opportunity, especially as a CPG company. Settle just like gets us, right? MyPocketCFO just gets us. And that's just so nice to have. Sometimes when you go to banks, they don't understand holding inventory. And it's a really interesting conversation because when I explain lead times and what that looks like and why we need to produce at this time, they're like, well, I don't understand. You have inventory. That inventory is going to be sold. This is inventory for future. So having a company like Settle really take into account future projections for a company like us, that is very helpful because we can't show you, this historical, we can show you historical growth, but a very large retail account is different, and being able to have a partner and the right partner be able to support that growth is just so valuable to us. So our experience with both platforms have just been seamless.
Awesome. Okay, cool. Wow, we're literally running a little bit short of time. We only have about 10 minutes left, so I want to go ahead and let's move to Q&A session. If you do have any question, again, feel free to type that in the chat box. We will go through that together. Or if you want to raise your hand, you want to just show up and talk, raise your hand and we will call your name. Anyone wants be the first one, the brave one? So while I think while you are thinking, or if you want to work with, let's say, SETTLE or MyPocketCFO, you have any specific question, also feel free to type in the chat as well. No questions, everyone. I saw something. Did someone ask a question? Anyway, I think while you're thinking, again, feel free to type in the web chat. I would say, Ash, if you could move to the special offering. I know we have a lot of detailed wealth of knowledge packed in a very short period of time. I would say you can always follow up with any one of us. You can follow up with Keanna, with me, and with Ash on any specific questions. And specifically for the people who participate in the live meeting today, SETTLE and MyPocketCFO, we are working really together. We're trying to really make this capital, I would say, working capital management easier. So we're offering for the participants a special VIP package. So this is a SETTLE's offering. I know it's a lot of detail here. I believe we're gonna send it out in PDF format afterwards for all the audience. So if you do want to take advantage of this offering, feel free to follow up. The biggest headline of this offering from my perspective is you can we talk about optimizing your accounts payable. So I believe SETTLE has this new product coming along or coming together with their alternative working capital financing, is you could use their bill pay to manage their accounts payable. And with the special package, you get 2 free months to try out the SETTLE's bill pay program. Keanna, anything you want to add for the offering here?
No, nothing to note.
Cool. Yeah, so if you want to take advantage of that, feel free to follow up. Anna, I want to ask, how would people follow up if they want to take advantage of this offer?
Great question. So, like you said, we'll send out all this information, and then when you go to sign up, just shoot an email to hello@settle.com, or sorry, .co, and we'll get you all set up with the discount.
Cool. Okay, yeah. I saw a question, will you be sending out the recording? Yes, we will be sending out the recording along with the material. And Ash, if you move to the next slide, I would say, so in the spirit of partnering with SETTLE, and for the people who signed up, from MyPocketCFO side, we have a simple subscription SaaS package. Today, we charge $199 per month. So for the audience who want to sign up, we offer a special VIP package to give you $99 per month for the first 2 months, so that you could try out our product, where we can get you an accurate financial statement within days, basically, and which I believe will help you to present your accurate financial statements in front of the lenders like SETTLE. And we are also in the process of launching our next gen product, which will be AI powered, and you will also get early access to this new product in about a month or 2 time frame. Obviously, come together with this one if you do want to set up a free review session with your current financial statement. Before you reveal that to lenders like SETTLE, we'd be happy to do a free review session with you. So me and my co-founder partner Eric, we can do a free review with no strings attached of your current financial statement, and give you suggestions on how you on your readiness to approach a lender, or ways to optimize your financial statements. And if you do want to engage with any of the offerings, you can send an email to me, to my personal email, and with the subject line, MyPocketCFO × SETTLE VIP, we will follow up with you. Someone had a question. I thought there were some background questions.
Yeah, I can jump in on these. Looks like Samuel, you asked, can Nigerians participate as well? I'm assuming this is towards the financing side. SETTLE is limited to funding only US-based businesses. What this means is that you have an entity here, you have a bank account here, and sales are primarily operating here. We do partner with, or we do work with companies who maybe have foreign parent entities, but local US subsidiaries. The underwriting does become a little bit complex, though, depending on how cash is moving in and out of the US. So if you do have a US subsidiary that's generating at least $500K in revenue per year, that would be an option for financing with SETTLE. Alice, I'm not sure what limitations or requirements you have for jurisdiction of companies that you work with.
That's a great question, and the answer is surprisingly similar. We are a early stage fintech startup. At this point of time, we only serve companies in the US. So if you're not operate, meaning if your office location and if you don't have a US bank, we actually cannot serve you because in order for us to administer your accounting book, you have to have a bank in the US and you have to register as a US-based company. With that being said, in the future, we do plan to expand. So if you want to stay in the community, in the email list, the newsletter list, do welcome, I would say. I'm sure I'm speaking probably for SETTLE and Keanna. I'm sure we have plans in the future to expand internationally, but at this point of time, we also just serve US clients.
Great. And it looks like Josh had a question regarding working with hemp businesses. A bit of a kind of complicated answer in that typically any business that operates in the CBD, hemp, marijuana type space, we usually have to partner with our legal team to understand if it's something from a regulatory perspective that we can help finance. And the reason actually comes from our banking partners that we use to facilitate our business have very strict requirements on the.
Oh, you're on mute, Keanna.
Yep, it looks like someone muted me. Sorry about that. Sorry, as what I was saying was the restrictions come from our banking partners, which limits our ability to lend to companies who operate in this space. So kind of echo your sentiment in that the banking partners, the lending solutions that are available to these types of companies are pretty limited. However, sometimes what I've seen be successful is that if a company can kind of provide more descriptive analysis on the technicalities of their product, how it doesn't have components of THC. Sometimes there are adjacent type products that we can support. But again, we have to partner with our legal team to understand more. So we always say we're welcome to a conversation. There's additional diligence that has to be done. But as for typical working capital solutions out in market that do support these businesses, I'm pretty unfamiliar with those.
Thank you, Keanna. Actually, that's a great question. We do work with some hemp or marijuana-based businesses. Again, that's it's a little bit, I would say, ahead of the curve. We do have to explore a number of areas when it comes to like a payment solution, when it comes to financing solution. But like Keanna said, I think the same with MyPocketCFO. We are open to talk to you, and we are open to helping you to get started and manage your business. So from that perspective, we can always talk to you and see if there's a solution that can be found. All right, if there's no other questions, I think we're coming to coming to the time. Thank you so much. Again, I learned so much from you, Keanna, and Ash. Thank you for being here and sharing your experience working with both of the companies. We will send out a follow-up with the recording as well as the materials. And I hope this is just the beginning of the community events we have for cash flow management. I hope to do more, and I hope to partner with you, Keanna and SETTLE, to do more to this community.
Thank you guys so much. We really appreciate your attendance, and please reach out to Alice, Ash, myself with any questions you have. We'd be happy to have a discussion.
Yes. Thank you, everyone. Thank you, Keanna. Thank you, Ash. Talk to you later.
Bye, everyone. Thank you.
Bye.